guys. Hi, sir, the option seller.
Hello, Raghav.
Welcome everybody to our Twitter Spaces. We want to thank. Uh, I think I'll call you Mr. Option Seller for the rest of the spaces. Is that okay?
Yes, absolutely fine. Thank
So
you.
we have Mr. Option Seller here, and we want to thank him for taking out the time. It is expiry. I know a lot of you guys, a lot of you guys have been trading today. Expiry trading is people can miss other days of the week, but generally most people do not miss trading on expiries. So I'm sure you guys are all battle hardened from today's expiry, and um, like I said, we want to thank Mr. Option Seller for joining us. Before we jump into how he trades, we just want to start with, sir. Why don't you just give us a brief intro about yourself? We start from there.
Yeah, sure. Hi, everyone. Let me talk about my background a bit. I'm based in Delhi NCR. I'm primarily a business guy, so I have a few, couple of businesses that I run. One of them is a family business, and from my trading background is that I've been in the markets for the last, I would say, now 19 years. I started investing in the markets in 2003, and then when the when the 2008 kind of crash came, uh, that's when I realized that the money can be made even when the markets are going down. So I got introduced to the futures and options world at that time. So I started, like any newbie, I started trading in futures, and initially lost a lot of money for a few years, but I always kept my capital very low because I wanted to learn on a very small capital base, and uh, started. So from futures, when I started losing a lot of money, I started dabbling into options as well. So I started trading in options in 2013, 2014, and but at that time I was an option buyer, right? So I think every trader goes through a learning curve. Everybody starts with equities, then they kind of graduate to futures, then they realize that future is a high risk game. So what's the other option? You start doing options, and like any newbie, an option trader always starts with buying because buying promises unlimited reward with a limited risk. So I started option buying. I did that for 3-4 years, so a combination of future buying and option buying. But then in 2018 is when I realized that money can be consistently made through option selling, and that's when I started doing option selling. And initially I used to do both intraday and positional option selling, but then in 2019, uh, I got introduced to a broker that was allowing intraday leverage, uh, and that's when I started actively doing option expiry, selling. So I've been doing option expiry selling now for the last 3 years. This is before COVID, is when I started, and I've been, after spending good 19 years in the stock market, I've realized that consistent money can be made through option selling, and that too by just doing expiry. So my trading style is very much, 95% of my trades in a week are on expiry day, and then on other days I take very small trades against my equity holdings, or to use my idle capital. So those trades are probably 5% of my overall trading quantity. 95% of my quantity comes from expiry day. So that's what my background is. And so Delhi NCR, business background, started doing trading as a side income, kind of opportunity. Until today, I'm not a full time trader, so I still look at trading as a side income for myself. Though the trading income has gone up dramatically in the last 3-4 years since I started doing expiry trading, and that's why I have scaled up my capital as well slowly, from a very low base to a reasonable size now for an option seller.
Thanks for that intro, sir. So a couple of things that really stood out, when you're running two businesses as your full-time profession. One of them is a family business, and option selling or option trading rather, or just I should say trading in general, is sort of a part-time side gig for you that's generating a sizable income, as we can see by her daily screenshot. So kudos on having the longevity of being a part-time trader, and having that longevity. So just to go a little bit over your background, you started trading in the early 2000s. You uh, got through the 2008 crash. That's when you realized that there is an interesting opportunity in all kinds of market movements, and not just a uh, general up movement of the overall market. So can we also ask what your educational background is? Is it quantitative or please go ahead.
Yeah, so I'm a academically I've studied accounts and finance. So I used to be a finance professional. I've
Got
done
it.
my BCom honors and my chartered accountancy. But to be honest, you know, initially it helps, but you really don't need to be a finance whiz kid to be good at making money through stock market. So I don't want the listeners to assume that just because I've got a finance and accounting background, that's why I'm successful. That's not the reason at all. You just need to understand basic mathematics. You should be just good at adding and subtracting and multiplying and dividing mentally, and you are good to go in stock markets.
Yeah, no, that's exactly right. In fact, one of the having traded in the American markets, one of the sort of first trading interviews, or the first round of most interviews that I took with trading firms. The first round was mostly just, and these are multi trading firms which manage hundreds of millions of dollars of capital, and they have sort of a hiring program where they hire freshers every year, similar to the way the IT industry hires freshers in India. There's sort of like a pipeline of hiring trading interns, assistant traders in the US. And one of the only things, like the key component of the first round of interview, was precisely just this: mental arithmetic, just arithmetic, addition, subtraction, multiplication, etc. So yeah, so the reason I asked your education background was just to complete, sort of like, we understood your work experience. Just wanted to get a complete picture. So you started with option buying. How was that journey, sir, in the option space?
Yeah, so I actually started option buying as a hedge initially, right? So I used to go long and short in futures. Used to trade in all stock futures, index futures, uh, because futures used to give good leverage. I didn't, as I said, I started with a very small capital because I wanted to. I knew I'll burn this capital, right? So I was ready to lose small amount of money in the market to learn. And futures used to give good leverage at that time. So I started trading futures, and option buying was primarily, as a hedge for my future. So if I'm going long, let's say in Reliance, I would at that time buy a Reliance put to just cap my, loss on the downside, and vice versa. So I did that for some time, but as I said, future buying and selling, what I realized was that you have to be really good at reading charts, and technical analysis has to be good. And even after that, every trade that you take, you only have a 50% chance of that going in your direction, and 50% chance that it will go against you. So every single trade that you take in futures, there's only a 50-50 probability that it'll give you a profit. So I used to do that stock option buying at that time as a hedge. And to be honest, I lost money on both, right? I was losing money trading futures, and I was losing money on the hedges as well. So very quickly, in a couple of years, I realized that this is not something which you can make money on consistently. And psychologically, I believe for a trader to survive for long term in the stock market, you need to have a regular income generating strategy in the stock market. If you don't have a regular income generating strategy, then it's very, very difficult for a trader to survive for a long time, right? And you need to be, I mean, there are traders who would, who would run in losses for 3 months, 4 months, 5 months, and then they'll make huge profits in the next 7 months. And, kudos to them. But you have to be mentally very, very strong as a human being to be able to survive that, 3, 4 months of drawdown. So, and I'm, to be honest, I'm not that mentally strong. I was not that mentally strong at that time. So I decided that, trading futures and options uh, as a hedge is not my game, because, I can't, I can't see drawdowns, significant drawdowns on my account. So, so that journey, as I said, 80%, 90% of the times, whenever I bought options, I lost. And I stopped doing that, and that's how I, option selling attracted me. That's how I got attracted towards it, and that's how I started learning more about how to make money using option selling strategies. And I think that will be my advice to all the traders who are, who are listening, as well as traders who talk to me initially, people who was just starting their journey, is, don't do option buying just because it promises unlimited profit for a limited risk. 99% or even more than that, option buyers actually end up losing money. There's only a very small fraction of traders who actually make money by option buying. So, there are people who make money by option buying, but that's a very small population. And you need to be really, 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 like, you need to stick to the terminal the entire day to make money for as an option buyer. But as an option seller, you can actually, you have time to do other things in life as well, once you have sold an option. So, and as I was a part-time trader, I could not stick to the terminal the entire day as an option buyer. So the only choice I had was to stop losing money and find something which takes limited amount of time but gives maximum return. So, the way I calculate returns is both on capital deployed as well as time invested. So I always wanted to look for strategies that will give me maximum return for minimum time invested in the stock market.
That's really interesting. Really, really interesting. So, um, a few things, the first thing that you mentioned that really struck out was, you allocated a small amount of capital that you had sort of assumed that this is my capital that I can afford to burn. So this is essentially learning capital, right? And I think that is a really, really, if you can afford that, that's a really, really good way to start, where your skin is going to be in the game. It's a different approach than the popularized, extremely popular paid webinar approach that exists in the Indian markets today. But there is nothing that will teach you better than actually putting some money in the markets, sort of observing your own psychological makeup as you see that money that you have invested, that trade that you have taken, that red and green flickering on the screen, like having going through that experience, and also trying to build that self awareness about yourself, which is also something that you mentioned, where you said that your strategies were long put, right? So it's essentially buying protective puts, and losing on both fronts, and just sort of like understanding, okay, boss, this game is not for me. I have uh, paid my due. The burn, the amount that I thought I can burn, I burnt, and it's a good way to sort of course, like, only if you can afford it. It's a good way to start learning about the market, right? The second thing is
Absolutely.
also, yeah, yeah. So the second thing here is also sort of understanding the having the self awareness, to understand that there is a psychology associated with option buying, because traditionally option buying systems have a lower winning percentage, and feeling those losses, because your losses are going to be more than your wins. The idea of a profitable option strategy in general is that you win rarely, but when you win big. So going day after day, seeing the red on the screen, and uh, like, your backtest report may show a profit, and your strategy in general may also be profitable in the long run, but sort of coming to terms with that asymmetry is not everybody's cup of tea. And kudos to you for understanding that, understanding your own limitation, having that self awareness, and then saying, okay, boss, this is not for me. Let me try the other approach, which is a higher winning percentage approach, which is usually associated with option option selling. And then
Yeah.
the third point that you mentioned that I found really interesting was using time as a resource. Like thinking of time as also something that it's not just you're not just measuring your cost in terms of the capital deployed. You're also measuring the amount of time, and that's really interesting because time is a resource for everybody, and everybody who's involved in the process of building out strategies. um, you have to sort of time box how much time you're going to spend on the research phase before you actually find a strategy, and how much time you're actually going to spend paper trading or doing something on top of a successfully back tested system before you go live.
Yeah, yeah, we can hear you.
Yeah. Absolutely, absolutely. And I think, I'll just give a couple of examples to just labor that point, those first 2 points that you said, right? The first one was, learning by actually doing playing in the market, and not by sitting on the sidelines attending webinars or doing paper trading. Because I'm a big fan of cricket, and every you can learn cricket in a net, right? You can learn cricket indoors, and under a coach, and the coach will tell you how to play a short ball and how to play a full toss and all that. But the real learning actually happens when you are standing on the pitch playing a match, right? You that feeling is absolutely different. And the amount of learning that you have when you actually play a few matches is very different to what you learn when you are just batting in the nets. So my approach from day one has always been, I have never done paper trading. I have never ever kind of wasted my time there. If I want to test something out, a strategy or a system, I've always played with real money, but a very small amount, right? So start with you can start with 2 lakh rupees, and you can start with just buying and selling one share, or just doing one lot if you want to test something out. But if you don't train your mind to actually see that, as you said, that red and green flickering on the screen, you will never become a successful trader by just doing paper trading or attending trainings. That's one. The second point which you said, which is self awareness, and the ability to actually take losses for a long time, during a drawdown period. That's very important, because human brain, if you think about it, human brain is trained to remember bad experiences longer. Okay, and I'll give you an example. Just imagine you have a friend, right? You go to a friend every day to meet that person, and that friend, he beats you 3 times. So you go on Monday, he beats you up, abuses you, sends you back. On Tuesday, you go back again, he beats you up, sends you back. On Wednesday, he beats you up again, sends you back. On Thursday, you go, right? He'll take you out for dinner and he'll talk very nicely to you. On Friday, you go, he'll beat you up again. Now, as a human being, I don't think anybody would want to meet that friend again. We will try to run away, right, from that friend. Nobody wants to be in a relationship where on a daily basis you are being, you are being, uh, you're feeling like a loser, right? And only on a few days you feel like a winner, and that feeling is great, but then next day again you are being slapped on the face. So human brains are trained to enjoy small gains. But if there is a small loss, the human brain kind of reacts very negatively to it and remembers it and tries to run away from it. So my philosophy has always been that I don't want to trade a system that gives me small losses for 3 days, 4 days, and then on fifth day it will give me a big profit. Because that's, yeah, that's not how my brain can actually, that's not my psychology, right? So I'm happy to get small gains every day, 3 days out of 5 days, or 4 days out of 5 days. I'm happy with small gains, instead of making losses for 4 days and then fifth day I make big profit. So that's, I think that's very important for people to understand, that if we are following a strategy, understand yourself. What is your psychology? Are you ready to meet a friend who slaps you every day, but on the fifth day will take you to a five-star hotel and treat you? Or are you a person who wants to meet a friend who's nice to you every day, right? Somebody who's nice to you every day, maybe abuses you on 1 or 2 days, but on the other rest of the days, you're being treated nicely. What kind of person are you, right? It's very important to self I would say assess your psychology. And as a part-time trader, obviously time is a important resource for me. So my opportunity cost, right? In economics, you have got this opportunity cost thing. Uh, I have to look at, okay, what do I gain if I spend 4 hours in my business versus 4 hours looking, sitting in front of the screen and doing trading, and if trading is not giving me more than what I'll get otherwise through a job or through a business, then there is no point trading, right? So please consider, everybody should consider their time as a resource as well.
Yeah, excellent, excellent. I think the asymmetry of the human psychology in taking more pains when it's a loss, an equal amount of loss, like risk aversion. Essentially, that's what it is, right? Human nature is
Absolutely.
essentially risk averse, and understanding that and tailoring your trading around that is also something that I think is a
Yeah,
great point.
it's it's risk aversion plus most of the human beings are egoist people, right? They want to uh, you know stay in a high confidence state, right? Nobody wants to be in a situation where you are losing confidence every day, and what consecutive losses do is they take away the confidence of a trader, even if they are small losses, right? And that's why most of the people end up giving up on a strategy after 3 4 5 days of losses, or 1 month of losses, because your confidence goes for a toss. So why to even follow a strategy where based on back tested data that the drawdown is like 30 days or 40 days?
Fair enough. Fair enough. So, at the moment, sir, how many? So, you're running. Uh, I take it that you're managing some amount of capital. How much capital are you managing, sir, at the moment?
So I'm not managing anyone
Your
else's
own
capital.
capital, yeah.
I'm just trading, yeah, on my own capital. So my capital right now is slightly above 2 crores.
Hmm.
And I infuse fresh capital every year in my trading account. So I'm looking to infuse some more capital starting 1st of January.
Got it. Got it. And how many? So, how many different strategies do you run at the moment that you distribute that capital around?
Yeah. So primarily I've got 2 3 strategies, right? One strategy that I run is for expiry trading. And when I run that strategy on expiry, I deploy my 100% capital into that. On other days, on non-expiry days, I would typically, deploy only 50 60% of my capital. And these are strategies which are very low, uh, you know, ROI strategies, but the probability of profit is almost 90%. So as I said, my primary game is to make money through expiry trading. So
Mhm.
the other strategies that I run on other days are basically low ROI but very high probability of profit strategies.
So yeah, really, again, interesting that you're optimizing for uh, a higher probability of profit. And the amazing part here is that you have 2 crores of capital, and 100% of that is deployed on expiry trading. And I'm assuming, sir, that most of your returns actually come from that one day of trading every year, those
Oh,
52
absolutely.
expiries.
Absolutely. 95% or 90 to 95% of my yearly profit comes from those 52 days.
Mhm. So without giving away the strategy explicitly, without giving away any edge, can you tell us a little bit more about what your expiry trading setup looks like, sir?
Yeah, absolutely. I can share that. And I've done that in the past as well. In fact, I did a face to face session with Vivek Bajaj, some time back, and I shared one of my expiry strategies in that, so people can go on YouTube and even look that up. But nowadays, what I'm doing is, again, I'm becoming more miserly when it comes to time invested. So earlier I used to do expiry trading the entire day, but nowadays for the last I would say 3 4 months, uh, what I'm doing is I'm doing expiry trading only after 2 o'clock. So my total time invested in the market every week is 90 minutes, right? That's the time I sit in front of the screen uh, and do not take my eyes off. On all the other days, and even on expiry till 2 p.m., I'm not in front of my screen. I'm just in 2 hours or 3 hours, I'll just check it through my mobile, and that's it. So my expiry strategy is very simple. I want to sell options when the theta decay is highest, right? And we all know theta decay is highest on the last day of the expiry. And even within that, if you were to split the expiry day in 6 hours from 9:15 to 3:15, right? There are that's a 6 hour window. Even during that time, the maximum theta decay that you get as a trader is either in the first 1 hour, which is when the market opens, and the premiums start falling because there is some level of overnight decay, plus there is some level of decay which happens in the first hour of the morning, and then the maximum decay comes in the last 1 hour, uh, on expiry days. So what I prefer doing is trade in that last 1.5 hours of expiry days. So I start my trading, my 100% capital starts getting deployed after 2 o'clock on the expiry day. Before 2 o'clock, I just deployed 10, 15, 20% capital in the morning. And if I'm getting some amount of profit by 10:30, 11 o'clock, I'll take that, and then I'll keep my capital freed up till 2 o'clock, and then I'll jump in at 2 o'clock, and and then trade. So my strategy is very simple, right? I do strangles in Bank Nifty. I used to trade Nifty till last year, but then the premiums got too low, and there were just too many freak spikes coming in Nifty at that time. Whereas Bank Nifty also is known, it's notorious about spikes, but in Bank Nifty, because you've got a in Bank Nifty, because you've got a strike every 100 points, you can get an opportunity to actually adjust your position very quickly by not giving up too much premium. Whereas in Nifty, because the strikes are 50 points away, sometimes you cannot adjust and roll up or roll down your options, because the premiums in slightly far OTM strikes is absolutely negligible in the last 90 minutes. So I do Bank Nifty in the last 90 minutes, and it's all about selling strangles, right? So you look at the charts, and with again spending 13 years in the market, uh, some chart patterns get imprinted in your brain, right? So you can see what has happened throughout the day, and after that you get a 60%, 65%, a gut feel of what is going to happen in the last 90 minutes. So for example, today it was very clear, the Bank Nifty was falling since morning, but it was showing some positive divergence throughout the day when it was falling on RSI. And I've actually uploaded a video on YouTube. Again, people can go and watch it, where I've explained how to use RSI divergence on expiry days to make money. And people in my group, I've got a Telegram group as well, which people can join freely. People in the morning itself identified that RSI divergence, and they were selling puts throughout the day. So, uh, so it's about selling strangles, but you keep an eye on the charts as well. And then based on your gut feel, whatever chart is saying, you can start with either a neutral strangle, or you can start with a skewed strangle. So for example, today I was selling more puts and less number of calls because of that negative divergence, and I expected a rally in the last 90 minutes, some sort of short covering in Bank Nifty, because Nifty was quite strong since morning, right? So I was expecting some short covering in the end. So I took a skewed strangle where the premiums that I was selling on put side was higher than the call side. So it's all about some level of chart reading, some level of applying some indicators or filters, and based on that you start opening strangles. They can be completely neutral strangles. So if you're selling let's say a 50 rupee, Bank Nifty put, you sell a 50 rupee Bank Nifty call as well. That's a neutral strangle, and then you keep managing that with a stop loss. And if you have got a view like today, then you can actually sell a 50 rupee put, and you can sell a 20 rupee call, and then you keep managing that, right? So these are the couple of strategies that I deploy. One is absolutely neutral, price neutral, and the other strategy is slightly skewed. What it does is that if my view goes right, then I make money in my skewed strangle, and I manage my neutral strangle as well, in the last 90 minutes, and I end up making money in both. But on days where my view goes wrong, I will lose less money in my skewed strangle, but I'll make good money in my neutral strangle, right? So it's kind of when you are winning, you win more, and when you lose less. I think that's the mantra. Uh, and because I'm doing it in the last 90 minutes, market have to really go very crazy in the last 90 minutes for me to make a loss. Otherwise, the premium decay is so fast. On 85, 90% of the days, I end up making money because of that. So, and and I share my expiry results every Thursday on Twitter, and people can actually go back for the last 3 years that I have been posting and actually look at all my expiry day results. I think 90% of the times I have made profit. Whenever I have made a loss, it's usually a smaller loss. I mean, whenever I made a big loss, that has happened maybe 2 3 times in the last 3 years. And when I say big, I mean that's within 2% of my capital. That I call big. So my tolerance for loss is very small on expiries as well. So I would have lost 2% only on 2 3 times in the last 3 years, and even those days, either my system, the broker system got kind of stuck, or my system got stuck and I could not exit my positions in time. That's when I lose money. Otherwise, on 90% of the days, I end up making some money. Sometimes small money, sometimes good return. But I'm happy to make 0.5% to 1% return every expiry. That's what my target is usually. I don't target 3% or 5% returns each expiry, and I think that's another thing to really absorb for people, that if you target small gains, if you keep small targets, your probability of profit goes up dramatically. And small gains over a period of time, because of compounding, works beautifully. It will keep your confidence high as a trader. You will trade positively with a positive mindset, and your account size will keep on growing every month, and that's a great feeling as a trader to have, right? So it's important for people to understand that targeting low returns but more assured returns is much better than taking high risk for higher returns. Because in markets, if you're taking higher risk, there will be a string of losses which will create such a big drawdown on your account that it will take months for you to come out of that drawdown. So I would rather target smaller profits, but where the probability of profit is more than 90%.
Wow, excellent. So just so much material there, sir. First of all, I think it's really, really amazing that in the last 90 minutes, you end up deploying, like you said, 80 to 90% of your capital. And I'm assuming that it seems like you have a system, but the execution here is done in a manual manner. Is that correct?
Yes, currently I'm doing it manually, but I want to move to Algos as my capital size is growing,
Yeah.
because there is a limit by the exchange. You can't trade more than 1200 quantity of Bank Nifty, and if you are trading with large capital, you have to have some sort of order slicing
Yeah.
tools, etc., etc. So sometimes with big capital, it becomes difficult to trade manually. So I want to shift to algos gradually, but yes, right now uh, it's all manual right now, and I can live with that because I'm trading only for 90 minutes, so it's not that high stress, kind of manual work either.
Yeah, I think it's really interesting just for somebody like me who like I've done some manual order punching in my time, but the fact that in 90 minutes you have, I mean, it's almost like in a movie, where you have like 90 minutes to do this, and you do it every Thursday. I think that's super interesting, and the fact that you usually people when their capital size increases, they tend to face a diversification problem, strategy diversification problem, which is why they decide, okay, let's go into like different systematic strategies. Here the interesting constraint is that you can't punch a large enough order. You're like, man, like there is a 1200 lot limit, and my capital size is increasing. I want to keep doing this strategy, and I can do it manually if only you can allow me to manually punch a larger size. I think that is also really, really interesting. But the crazy thing here is, like 90 minutes every Thursday, and I was looking at your Twitter profile. You had a 46%. Uh, Basically, over the last 2 years, you've made 40% CAGR for both those years, which is also really, really interesting. Um, Now, the next question, sir, again, like the caveat here is you can reveal as much as you want to, is around strike selection, where you said, you have two kinds of, two sort of buckets in which you are trading. One is the like a neutral triangle versus a skewed triangle. So, out of either of the two that you would like to discuss, what is your methodology for selecting strikes?
Yeah, so that's a good question. So again, I'll go back to my trading style. As I said, my psychology is to make small amount of money, but with a high probability of profit. Now that can happen only if you stay out of the money on expiry, right? So as soon as you start selecting strikes, which is close to ATM, you are taking higher risk, but you are gunning for higher returns. My system is to gun for lower returns, but take as low risk as possible. So my strikes are typically, when I start at 2 o'clock, my strikes are typically 200 to 300 points away from ATM. And as things get closer to 3 o'clock, that's when I start coming closer to ATM. But I try to stay at least 200 points away from ATM after 2 o'clock, and that's
Got
for
it.
bank.
Got it. Got it. Uh, Now, the next question I have, sir, is if you can just spend, small amount of time talking about what you saw today. I think it will be the most fresh in your mind today. What you saw today in terms of that RSI divergence. Maybe you can give a quick intro to that, and introduce your Telegram channel. You can mention that again. The idea here is that we're trying to understand what is this RSI divergence that you saw, and how did it lead to you having a view on saying, "Okay, I am going to skew my triangle here, or the skewed triangle that I usually do is going to be heavily skewed towards selling more puts than calls."
Yeah. Sure. So again, I don't know if we can share screen here through, and I'm on phone, so I can't show my screen. But if people go to today's, kind of Bank Nifty spot charts, and I usually watch 5 minute charts because I think that's good enough for a trader who's trading only for 90 minutes. And if you open Bank Nifty charts for for today and plot 5 minutes time interval, you'll see that Bank Nifty, when it opened gap down, and then it kept falling for the first half an hour, right? So it opened at around 40,150, and then it within first 30 35 minutes it made a low of 39,900. So it kind of literally fell 250 points. At that time, if you plot RSI 14, the RSI 14 actually had made a low because Bank Nifty was falling. But after that, Bank Nifty kept chopping, and then made a fresh day low at 1110. So the first low was made at 945, and the second day low was made at 1110. Right. So while Bank Nifty was falling, if you look at RSI was not making a fresh low. RSI at that time was actually making a higher low. So a typical definition of a divergence is when your instrument is making a lower low, but your indicator is making a higher low. That is called a positive divergence. It means that indicator is suggesting that the momentum of the fall is reducing. The momentum, the speed at which the instrument is falling is not the same. The velocity of the fall is slowing down. That's what the indicator is telling you, right? Similarly, if if the instrument is making a higher high during the day, but the indicator is making a lower high, that means that the velocity, the speed, the momentum at which the instrument is going up is slowing down, right? So that is called a negative divergence, that the indicator is saying that, hey, you know what, the instrument cannot go up with the same speed throughout the day. It will either go up slowly, or it will become flat, or it will actually give a pullback and revert to the mean, right? That's what the divergences usually tell. So if you look at the RSI divergence today at 11:45, the RSI was making a higher low as compared to the low the RSI made at 9:45. Yeah, are you able to see that?
Yeah, I'm seeing it on the chart, and I'm seeing the divergence as well on the
Yeah.
RSI 14. Very quite interesting, sir.
Yeah.
Uh,
So usually what it means at 11:45, when the divergence was becoming evident, what
mhm.
I knew, or what a lot of people who saw my YouTube video and they learned this method, what you do basically is you extend you draw a trend line joining the two lows on the instrument, and you extend it till 315. So basically, what that trend line will show is that if the market keeps falling, till what level can it fall today, right? So if you draw a trend line where you are, uh, joining the low that was made at 945 and the low that was made at 1145 on Bank Nifty, and if you stretch that till 315, right? If you stretch that till 315 or 330, right? What it shows is that if the market keeps on falling at the same speed, Bank Nifty will close somewhere at 39,700 at
Correct.
315,
Correct. Yeah, yeah.
right?
I think the two times are one is the sorry, one is the 9:45, and you join the 11:10 on the
1110.
5 minute.
Yeah,
Yes.
1110. Yeah.
Yeah.
If you
So
join those two
yeah.
lows and you stretch that line till 330, that
Correct.
line stops at around 39,700.
Correct.
So what it means is that because your indicator is saying that, hey, you know what, the speed of fall is slowing down.
Mm-hmm.
Okay. You are you are basically you are basically telling yourself mentally that okay, the indicator is telling me. Can you guys hear me?
Yeah, yeah. We can hear you.
Yeah. So the indicator is telling you that the speed of the fall is slowing down. But what you do tell your brain is that okay, even if the speed remains the same, till what level will the market fall? And this trend line will tell you till what level the market can fall at the same speed.
Mm-hmm.
Okay. Now at 11:10, right? You know that okay, market may close somewhere at around 39,600, 700, right? So what you know is that if you sell puts which are below that level, they are relatively safe.
Correct.
They will not become in the money. So what you start doing is you start selling puts at 1110 which are lower than 39,700.
Okay. So 39,600,
39,600,
39,500.
39,500, whatever.
Correct.
Okay. And the stop loss is very simple. If this trend line breaks, if the market falls with much higher speed and the trend line breaks,
Mm-hmm.
then you exit.
Okay. So the closing of the break is a closing, or can
Yeah,
it just
break is the closing, right? If the candle
got
closes below the trend line,
all right?
then basically the market is saying that, hey, you know what, I am ready to fall with a higher speed than what I was falling at earlier.
Got it.
So
Got
you take a small loss, you exit, and you wait for the divergence to play out again. If the market after making a new low, again pulls back up, then
it.
you
Mm-hmm.
know that okay, this low was just a freak low to kind of push out the put sellers, and then you can start selling puts again.
Got it.
Right.
Got
So
it.
it was very clear at 11:10 that market will show some sort of short covering during the day. It will either go up or it will become flat, or if it falls, it will fall at a very slow speed.
Mm-hmm.
And that's exactly what happened. So when I started trading at 2 o'clock, at that time, if you see, market was at around 39,900.
At 2 o'clock. Yes.
Yeah, the market was around 39,900. So very clear, I'm expecting an up move because there's a divergence. I don't expect anything below 39,600 to become in the money. So
Mm-hmm.
I started selling, 39,600 puts, which was roughly 300 points away heavily.
Mm-hmm.
And I started selling some calls which are, like above day highs because I know that it will take a lot of effort for the market to break the day high. So if I'm selling something which is trading at, let's say, 15 rupees, 20 rupees as a
Mm-hmm.
put, then I am selling something which is trading at, let's say, 7 rupees as a call.
Okay.
And the idea is to eat that entire 20 rupees, 22 rupees.
Got it.
And
Got
then
it.
you keep selling, doing that, and you keep looking at the charts. I think I was in good profit still 310 today.
Mm-hmm.
But as the market obviously is getting closer to uh,
The day
close,
high.
then
Yeah.
the entire decay in out of the money options happen, and then to make some money you have to come closer to the market, right? So I came close to the market. I sold 40,100 calls, and then market suddenly in the last 20 minutes jumped up and went above 40,100.
Mm-hmm.
I remember, I think that option, that call was trading at 1 rupee 80 paisa or 2 rupees. And then
Mm-hmm.
from there, it went to 20 rupees.
Oh, okay.
So I had to take a small loss on that strike, but overall I was in good profits. Till 310, so it didn't hurt much. So I think sometimes that will happen in the last 90 minutes. You can't do much about it. Market, will give you money in 90% of the cases. But yes, there will be some days where it will take some money in the last 10 minutes. So be it.
So did you put a stop loss on the call as well?
Yeah, I always have a mental stop loss, and I sometimes put it in the system as well. I always have a mental stop loss of anything between 50% to 100%. So if a call is trading at, let's say, 10 rupees and I'm selling it, then I'll always have a stop loss of either 15 or 20. And sometimes I exit half at 15, and then I would exit the other half at 20. So the average exit price comes to be around 17.5, which is like 75% stop loss overall, right? So that's how and it again depends on the premium and how much premium am I selling. If I'm selling higher premium, then my stop loss might be just 30-40%. If I'm selling very low premium, like 5 rupees, 6 rupees, then my stop loss can be 100% as well.
Got it. Got it. Yep.
So it's all about selling strangles, staying away from the market, looking at these divergences, which can give you a hint of where the market will go, or rather where the market will not go. And then basis that you create a hypothesis, and then you start selling options on that. So my hypothesis today was market won't go down below 39,700, and on the upside I wasn't expecting the day high to be broken, so I started my strangles with those two levels, and then I just kept bringing them together throughout the as the market progressed, right?
Got it.
Yeah, excellently articulated, sir. Especially, like starting from what the divergence actually means on the upside and on the downside, and then I think it's really, really well articulated. The fact that um, we're doing this in sort of like a radio, right? Twitter Space is essentially a radio, and usme, uh, like I'm sure, hopefully others were also following what Chintan was doing in front of the chart, but excellently done. So I think what
And
we'll do is,
what I'll do is I'll post the chart on Twitter after this, and people
perfect,
can look at that chart and understand. Yeah.
Yeah, we
perfect, sir.
compile that in the video as well that we post on YouTube, so that should help.
Yeah.
Perfect.
And you could tag us on the tweet, and that'll be great.
Yeah, we'll
Yeah.
do that.
Yeah.
Perfect, sir. Perfect. Uh, uh, Chintan, you want to ask some other questions, or otherwise we can actually open it to the floor for questions if sir's okay with it.
Yeah, I've got a hard stop at 5 o'clock, so yeah,
Yeah.
I
Then
would like
let's
to
open
close
it.
at 5.
Let's take some questions.
10
So
minutes of questions, guys. You can request
yeah,
your questions if you have any.
Sanjeev is being connected. Sanjeev, you can ask your question.
Yeah, okay. Thank you for allowing me, sir. So basically, I was just curious about today's last movement itself. So just sir has explained in the last. So could you tell us more about it? Means what we can do in such a movements, what we have faced in last 20-25 minutes today.
Yeah, Sanjeev. I mean, what you can do is basically take a small loss on that position, right? You can't fight with the market now. That 40,100 call, which where the market suddenly shot up. It went up to 20 rupees, and it could have gone to 50 rupees also. It could have gone to 80 rupees also. You never know. What markets can do. Markets could have shot up 150 points, 200 points in the last 10-15 minutes. I mean, if you look at the US dollar chart of yesterday, INR USD chart, and the rupee shot up like within half an hour, 45 minutes, it shot up like anything. So the best you can do in that scenario is take a small loss, and that's why keeping a stop loss in your system or stop loss in your head is very important. And as soon as you see that level on the screen, you can't you can't hold to hope and hope that the market will come down and the option will become zero. You have to exit it. And what I typically do is that if I'm, let's say, selling something at 10 rupees, I've got a mental stop loss of 15 rupees. As soon as the screen shows 15, I'll exit, right? Now, there are two scenarios. Either that option will go up and become 15, 20, 30 or whatever, or it will come down and try to become zero. So what I can do is I can always sell it when it comes down to 7, 8 rupees again, or 6 rupees again, or 5 rupees again, and recover my loss. Yeah. Something from 10 to 15, something which goes from 10 to 15 in the last 10, 15 minutes, and which again comes back to 5 rupees before the market close, there's a very high probability it will become zero. So, taking a small loss once doesn't mean that you can't recover that loss from that same strike. Or what you can also do is, if you have sold something at 10 rupees, you've exited it at 15 rupees, you've taken a 5 rupee loss, just look at the next strike. That strike might be selling for 2 rupees, 3 rupees. Just sell that and recover most of your loss from that strike. And then, if your original strike comes down to 4, 5 rupees, by that time that 3 rupees strike would have become 50 paisa. You book that 2.5 rupee profit there, and again sell it at 3 rupees, the original strike, right? So there are ways in which you can recover your loss very quickly.
Viranja, you can go
Hi,
next.
hi everybody. First of all, happy Diwali to everybody. I guess market ने आज
Thank
सबको
you.
दिवाली बोनस दिया अच्छे से.
Thank you.
मेरा क्वेश्चन था एल्गो, जब हम एल्गो स्ट्रेटजीज बनाते हैं, द क्वेश्चन इज बेस्ड ऑन दैट. मेरे को एक थोड़ा सा मतलब फोबिया बोलो या फियर रहता है कि सपोज व्हेनेवर वी आर क्रिएटिंग अ स्ट्रेटजी वी हैव टू ऑप्शंस, ईदर वी सेलेक्ट प्रीमियम और वी सेलेक्ट distance from the premium, say ATM, 1 OTM, 2 OTM. The thing is, Bank Nifty was not always the same price as we have today. So a premium, say in 2017 it was 20,000, then it moved to 30,000, then came back to 18,000, and then moving up. So, what do you suggest, sir? Should we select the premium, closest premium or premium range for backtesting strategies, or we should use that ATM, 1 OTM, something like that?
See, one thing which you can do is, select a premium range, but run the backtest for a particular year, right? So, for example, as you said, 2017 Bank Nifty was, let's say, at 20,000, right? 2018 it was at 25,000. 2019 it was at 35,000. Now, in 2020, it went down from like 40,000 to 25,000, right? So every year what the Bank Nifty average price was. So instead of running a backtest for the entire 4 years, what you can do is run a backtest for only 1 year. So you pick up to 2017 and you say, hey, during 2017, the average premium of something which was 2 to 3 strikes away was X. So you run that back test using that X as a premium range, right? Then you realize that, okay, in 2018, instead of X, it has now become X plus 50%, right? So earlier the premium used to be 20, now it is 30 because Bank Nifty has gone up this year. So for that year you use 30 and you run the back test on 30 premium. So you have to adjust your premium range based on what your current Bank Nifty level is. You don't have to change it every month, but I think year on year you should definitely change your range when you're backtesting. I don't like to use the same range for multiple year backtest because as you rightly said, the value of the underlying instrument will be very different in different years.
Just to inform everyone that Sir is backtesting a lot of strategies on our platform, and he has said that he'll be sharing some with everyone. So we are waiting for that.
Oh, absolutely. I love your platform. I think, I've used a couple of other platforms as well, which I won't name, but I've found your platform to be very, very user friendly, very, full of functionalities and logics, and quite economical as well for traders to use. So congratulations on creating such a nice, lovely, economical platform.
Thank you. And we have a mega Diwali sale also going on for unlimited packages. So you guys can check it out. Rushabh is next. Rushabh, you can ask your question.
Yeah, hi everyone. Happy Diwali in advance to everyone. My question was that sometimes at 2 o'clock on Thursdays on expiries, the premiums, for 200, 300 strike prices away are very, very low. So you just instinctively sometimes know that, there is probably more to lose than to gain. So is there a case to avoid a strangle on, at that time on an expiry, like when you can see the premiums are like very low and the movement is possible, when it's flat and then suddenly a move comes and then you are not able to handle it. So is there there a case for avoiding it on a certain day?
Yeah, I mean, I won't avoid any expiry day just because it has been flat since morning and the premiums are low. Because see, you always need to think about probabilities, right? If it's flat since morning, yes, there's a high probability of a wild move coming in the last 90 minutes. So what you can do is you can start with lower quantity. So I would not deploy my 100% capital at 2 o'clock on those days. I will deploy only 25% to start with. I'll wait for the move to come. If the move doesn't come till 2:15, I'll deploy another 25%. Then I'll wait for another 15 minutes. If the move still doesn't come at 2:30, I'll deploy another 25 minutes, right? So what will happen by 2:30? I would have already accumulated some profits on the positions that I created at 2 o'clock and 2:15, right? So I would have some profit buffer. And then when the move suddenly comes, then you have some capital to deploy at that time and make the most of that move. So on those days, what I generally do is start with a small capital deployment, and then keep building the deployment as we get closer to 3 o'clock.
Okay. Thanks. Great. Thank you.
Swamp Mill is next. Sorry.
Yeah, hello, sir. Yeah, hello, sir.
Hi.
Please go ahead.
Yeah, thank you so much for generously sharing the strategy, and I don't think many people will do that one. So anyway, just coming about the points, right? Like I wanted to know, like in general, you sell the OTM PCs, but what is your target? Kind of how much points per lot you aim to earn per lot, and do you also buy any hedges for that one just to increase the margin money?
Oh yes, absolutely. The advantage of trading after 2 o'clock is also that you can buy hedges at a very low price. So you can actually increase your quantity. And by increasing your quantity, you can actually not worry too much about how much premium. My target is to make 1 lakh rupees to 1.5 lakh rupees every expiry with 2 crore margin. That's what my target is. I really don't care how many points that means. On during high volatility period, I can make that money easily when the premium decays faster. During low volatility period, because the premiums are so low, I may make that money you know through by taking slightly more risk than what I would usually take. So if the premiums are too low, like one of the gentlemen said, I would probably sell 100 points OTM strangle, but with a small quantity, and wait for a big move to come. And when the big move comes, usually all the OTM strikes prices also go up, and then I'll deploy my rest of the capital in OTM, 200 points away, 300 points away, and still make the same amount of money. So my target is always, I need to make 1.5 lakh rupees on my 2 crore capital. It doesn't matter whether I'm making 10 points or 50 points or 5 points.
Last question, Mr. Rajaram.
Yeah, hi. Thank you. Would you call yourself a discretionary trader or a systematic trader? And in case in future you wanted to go for an automation, and if so, what kind of logic will you put into it?
Yeah, hi Rajaram. So a good question. So I will see, discretionary traders are people who generally take trades based on their chart reading and their gut feel. Systematic traders are people who do a lot of backtest, and then they develop a system which has a very clear entry point and exit point, and there is no kind of judgment involved in that. I would call myself a hybrid of both, because I've got a system, I've got a mental model where I say, okay, this is the strike price I have to sell with this premium. This is what my stop loss will be, and once that stop loss comes, I automatically the exit would happen. I won't even think twice. I don't even look at my PNL whether I'm running in green or red. I would just exit. Okay, that's where the systematic trading mindset comes in. The discretionary mindset comes in when I'm looking at the charts, and I can look at certain patterns, and like today there was a divergence, and then I can, based on that gut feel, I can skew my position, so I can tweak my system slightly and say, hey, you know what, I would not sell 300 point OTM or 200 point OTM put today. I'll sell 100 point OTM because I think based on my 18 years of experience and 18 years of chart reading, the market is going to go up today. So I would call myself a hybrid of both. And if I was to deploy an algo, I would obviously, create, and that's what I'm trying to do right now, working with a few, friends of mine. I would want to create a algo which is premium based and strike price based both. An algo which is smart enough to book profits when the decay has happened, significantly, and an algo which can shift and roll strikes when a stop loss is hit.
Uh, Great, sir. Uh, we know that you have a hard stop at 5, and we really appreciate the time that you've taken out from your busy schedule. Uh, Raghav?
Yeah, thanks a lot, sir. Thanks a lot, sir. Much appreciated. I think this 1 hour you've thrown a lot of knowledge bombs at the listeners, and we're going to post the spaces on our YouTube channel. It'll stick around on Twitter as well for a while. So thanks again, sir. Thanks so much. If you want to give any parting words, please go ahead. We're going to respect your 5 p.m. hard stop.
Yeah, thank you so much. No, I think the pleasure was all mine. It was a great experience, coming and talking to you. Some great quality questions. And again, as I said, I'm a part-time trader. I'm not a full-time trader, so there is no words of wisdom I can kind of share to part and close this session. But I just wanted to say happy Diwali to everyone and best of
Happy
luck for
Diwali.
your for the coming weeks of trading days. I hope everybody is able to grow their capital significantly. And I'm always available on Twitter. So if people have any questions, they can post it on Twitter, and I'll try to answer them to my best capability.
Thank you, sir. Just one last thing, guys, before we close out. We've got a really highly anticipated feature coming out soon, and you'd really want to get our Diwali sale and, make the most of that highly anticipated feature. Happy Diwali, guys.
Thank you.
Happy
Bye-bye.
All right.
Diwali, and thank
Thanks a
you,
lot,
sir.
guys. Happy
Sorry.
Diwali, everybody.